So the pass-through has occurred of the gain to the shareholders. So let's look at the shareholders and see what's happened so far. They're going to get a K1 that's going to record the deemed sale of the gain. And now they get a distribution back to C corporations. At that point, that distribution was considered a dividend, and they would have to pay tax yet again. The shareholders would have to pay tax yet again. Here in the S corporation, we get to revert back to S corporation rules, and this is what happens. And this will teach us quite a bit about the S corporation and their similarity to the LLCs that we learned about heretofore. The S corporation, since it's a pass-through entity, it doesn't have capital accounts, but it does have basis, what we call basis. And it's if you want to say the basis in our shares, you could say that. Basis in the shares. And that basis, not like when we just buy a stock on the market and our basis or our adjusted basis is what we pay for it. With these pass-through entities, this basis can go up and can go down. So the K1 with the deemed sale shows the gain, and for purposes of illustration, let's just pretend it's a $10,000 gain, and the shareholder will put it on their tax return where it belongs and pay the tax. That's part of the rule. They will pay a tax. It's a deemed sale, that's what the tax law says, and they will pay. Now they get the distribution of the $10,000, and the good news is that the distribution of the $10,000, and where does that distribution come about? The value of the property. It's the fair market value of the property, and it's considered a distribution to them. And so you might say, well, the C corporation, when that happened, the shareholders then paid another tax, a dividend tax, on receipt of the value of that property. So there have been two levels. Here at the pass-through, we've got good news for you. Let's suppose our stock basis in the S corporation was initially 0 when this transaction started. The K1 gain, and this is true of partnerships, and it's going to be true of S corporations as well, is the K1 gain, or any ordinary income, is in addition to our basis. So now our basis is $10,000. That's good news because we're now going to get our dividend, quote unquote, we're going to get a receipt of $10,000 fair market value to the shareholder, which will not be taxable because it's like it is a distribution. And what we learned in pass-through entities is that distributions are not taxable. And if you want to call it a dividend because it's coming from a S corporation, go right ahead. Distributions are not taxable. Not necessarily, anyway. So I'll say not taxable unless that's what we're going to find out. Although we covered that in class. So let's look at this case, though, before we look at the next scenario. This distribution, its fair market value is $10,000. It reduces basis to 0. Since we had the basis to take the distribution, it falls into the general rule that it's not taxable. It's a return of capital. Can't do that with C corporation dividends, which are the C corporation distributions, but we can do it here because it's the rules of pass-through. Now, had the basis at the beginning been not able to sustain, or let's do a different example, rather than trying to squeeze this example into the last example. New example, just to discuss further this concept of basis. So let's say our basis is $5,000. This is a completely new example to illustrate another principle of S corporations. It's $5,000, and the corporation K1 tells us that we have income of $2,500 from the business. So we add that to the basis because we're going to add income just like we did to the partnerships, LLCs. Our basis will now become $7,500. The next year, this is the end of 1 year, the next year there's a distribution. Company makes the decision that it has some excess cash that they can distribute to the owners. Everybody's happy about it, and they distribute this amount of money, $10,000 cash. Well, we've got an issue here. So the issue will work like this. We had basis of $7,500. So of the $10,000 cash distribution, the first $7,500 is a return of capital, bringing us down to a basis of 0. There's another $2,500. That $2,500 will be considered like a capital gain. We covered this in class. I just wanted to go over it again. We consider like a capital gain, pay tax at capital gain rates, at least. That's a little bit of a benefit because that's what it is, at cap gain rates. Okay, so that is the nutshell of what I want to go through. In addition to illustrating how C corporation rules default for S corporation rules when the S corporation rules don't tell you what to do. That's cool. Can't say that isn't cool. But the other thing we learned a little bit about is get this insight to the workings of the capital account inside an S corporation. And from here on, we won't call it a capital account because that's language relegated only to the LLCs, the partnerships. But it is our basis or our stock basis in the S corporation. And we'll see on a more academic level items about that next week.